Hi, this is Shane with the Rational Trader. It is Thursday the 24th. Let's take a look at each of the markets in turn. Here is gold. It was nice to see some trades in gold, actually. So we got long here. This gets 31 ticks. We're trailing by 20, so we make 11. And then what looks like the pullback, we get long again right there. Get a little messy to see. And you get taken out from -7 right there. And then you get long again and scratch out. So 5 ticks on the day. And then in the yen, let's see, -6, so it's one trade. It's right there, but I want to see what else happened here. So here's the open. This is nice movement. I like to see this. Okay, so no signals there that we're going to act on. As a human, I really like that. This, you can see the short-legged M pattern there. So right on that bar, things start to look interesting. You're getting a 121 signal there. Staying out of trouble at the POC, I like that. And then try to get long here, don't get filled. And actually, I think, was there another one earlier? Yeah, there's a long there, don't get filled. You would make 5 ticks the way we're trailing. And then the trade where we took the loss, yeah, the pullback short here. After the break lower, break lower, break lower at the value area low, get short, and then take a 6-tick loss, and then that's it for the day. All right, oil is the interesting one. So oil, that looks like a, oh my God, max loss, ugly day in oil. But what actually happened is the oil news was today at 8 o'clock. Normally it's Wednesdays at 7:30, but because of the holiday on Monday, it was pushed today at 8. So I put a blackout around that oil report at, so from 7:55 to 8:05, and that looks like this in terms of how we specify that. 6:05 to 7:55 is when I'll trade, then I'll stop, and I won't start again until 8:05, and then my normal end time 11:20. The problem is, if you look at what happened here, so I actually had to have a trade here kicking off before 7:55 when I would stop, and I'm still in that trade at 8 o'clock when the news comes out. And so I just take this horrendous slippage, so 10 ticks of slippage, for a 17-tick loss. All right, so we gotta figure something out there, because if I was here, I would exit the trade at 7:55. Instead, I don't have a clean way to exit that trade and then start trading again at 8:05. There's a way to tell Sierra chart you want to close any positions at a certain time, so you could do that. But then I don't know that you'll continue trading after that. Let's see. Let's take a look at that. That's in the spreadsheet here. So at the very bottom here, we say, time to flatten positions and cancel orders, and it's normally set for 1 minute before when the stock market closes. So just in case you're still in a position, this sets that to true or false, and what it does is it says if you're in a position, then be true. So you could change this value to 7:55. And I'm curious, would it then go ahead and take more trades? Yeah, I guess it would. Oh, that would work. The only problem is that it's possible that you could be in a position and then it wouldn't close at 12:59 like you would normally want. That's a partial solution. All right, so I got to think about that, because that's a problem. We end up besides taking this ugly slippage that takes me out of the market for the rest of the day. So let's see, what did we miss? So stay out of trouble at the POC, signal there that's not in our list, and then a peak out and fall. Another signal there also not in our list, but you can see neither of these are bad signals. Even that 241 looks nice. And then, okay, so there's a long there that I would have taken a loss on. And this is a problem. This is what I worry about in general when you're rotating around the value area edge. And so every bar you're looking. So what we want is when you have traveled to that value area edge, then look there, and there's an expectation you're going to travel away from it. But here you're rotating around it, which is I get worried that you're going to just get eaten alive. This is reasonable trade here because you're testing it and then breaking through. That's fine. So I like that we stayed out of trouble sort of after that. But there was a nice move after that, which would have been nice to be part of. And then what? This is kind of ugly here. And then we're done at this point. All right, so I need to think about how to deal with this case on Oil News Day, where you could be in a position at when the news comes out. That hasn't happened yet since I started this back in late November. In large part because we're so much choosier with our trades. So just the probability of being in a trade at that time is much lower than it was in the past. I'm going to change this back to the normal time, but we need to think about what to do on a regular basis for the Wednesday news report. Okay, so but with that loss, that's 2 max loss days in a row, regardless of sort of how it happened. So if you're trading oil and you took the same losses I took, you should stop for the week. That's the way you manage your risk. I'm willing to take, the way I'm set up, I can take a little bit more risk. So I'm going to go ahead and let it go tomorrow. I'm also running a test, so I'd kind of like to get every day into that test. But nonetheless, that's what we would normally do. It means that our the way that we're looking at the market does not match the current market conditions, and so just stop and reset at the beginning of the week. That's standard procedure for kind of the way I trade. But in general, January's been a tough month here, so it's looking to me like either I need more time in these tests of the analytical process, or if I use what I have, clearly the December time, the 4 weeks when we first started, were much better than this, and so that would suggest that I need to use that the 6-month approach to analysis. I have been, one of the problems that I have is that analysis is very laborious. It's fairly labor intensive. So I have been working on the program to make it not labor intensive, to either completely automate it or at least automate it to the point where it gives you more of a push button result, or gives me more of a push button result. And if I can do that, then it makes it a lot easier to simply run it every week, and or every couple weeks, and see what pops up and what the differences are with what you're currently trading. It also, one of the key things about it is that the method that we're using, I think we've covered this a number of times, but let me bring this up. The method that we're using is in the, hang on just a second here. So in the method that uses 6 months worth of data, we break it up into 4-week buckets and then look for common behaviors. And that works in oil because oil's got a fair amount of movement, but it doesn't work in like 6E. I couldn't find any common behaviors. And so my thought is that this use of 4 weeks as a bucket size is arbitrary. I just pulled that out of the air. And so what I'm doing is I'm setting up this program to be able to alter this value just automatically. And then so to be able to take a look at, well, what does it look like if I have three week buckets on 3 months of data, or 2 week buckets on 4 months of data, something like that. And then I suspect that what we'll find is that there is a sweet spot for each of the markets in terms of their character, their movement, and then how we define that commonality that we're looking for. So we'll see. We need some data in order to verify that hypothesis. So we're working on that. That's it for today. We'll see what tomorrow brings.